Hello, this is Mike Swanson. I run the website WallStreetWindow.com. And this morning, I just put out what is probably one of the most important posts, research notes that I've written on the markets in the past couple of years. I'm going to go through that with you. You can get all this information delivered straight to your email inbox, completely free too. If you click below in the description of this video, you'll see a link to subscribe to do just that. Now, we have seen last week the Federal Reserve turn more dovish. They said that the rate of inflation has not gone down, and they're projecting that it will actually go up a little bit. They upgraded GDP growth. And while doing that, they also said that they expect to lower interest rates 3 times this year. There was some talk that they may only do it, they may go to 2 times because of what's going on with inflation, but they stuck it to 3. Incredibly dovish statement. Stocks went up immediately afterwards. Gold soared, made a new all-time high in terms of price. The Fed has made it crystal clear we are not worried about inflation anymore. We are going to print more money. We're going to flood the system when we lower the rates. And traders acted accordingly. So let's talk about the article. Let's look at the charts and think about all this much more. You got to understand that by lowering rates now, or getting ready to do so this year, when the stock market's at all-time highs, when there's no recession, when you're seeing a soar in speculative assets such as Bitcoin, telling you that we are in easy money conditions now with where interest rates already are. So why lower them? Well, to lower them in this situation is to repeat what they did in 1998. Back in 1998, they lowered rates 3 times when the stock market was in a bull market, when there was no recession at all. And what happened? Internet stock bubble blew up in 1999 and going into 2000. And then when it peaked and went bust, everything went into a tailspin. The stock market fell for 2.5 years. The economy went into recession, and it was a debacle. The cuts of 98 turned into a disaster. And now here we are. You look at the stock market valuations, you can see the chart right here. This is the cyclically adjusted PE ratio. It takes the PE ratio of the S&P 500 and adjusts it for inflation over a 10-year average period. And last week marked the third highest close in that valuation metric in the entire history of the S&P 500. The stock market is overvalued. You would think the Fed would save the interest rate cuts for when there is a stock market decline, or when the economy is in recession, or when the unemployment numbers rise. But no, they're not going. They're saying they're not going to. They're not looking to do that. They're looking to cut anyway. Again, this is a wild policy. Why did they do that in 1998? Because the long-term capital hedge fund, a giant hedge fund at the time with connections to JP Morgan, Goldman Sachs, and the other major Wall Street banks, was about to go under. And it cried out, give me a cut. And the Fed delivered and bailed out not only the fund, but those that invested in it. That's why they did it. Why are they turning super dovish at this moment? Well, people have different theories. Maybe it's the election. Maybe they want things to keep going up, no matter what the consequences, to help out the current incumbent of the White House. maybe it's just because they know he'll keep their jobs. Maybe it's because they're scared if they don't cut and the economy slows down, the stock market goes down before the election, that they'll get blamed and they don't want to get blamed, so they'd rather cut. Or just maybe they realize that a lot of long-term debt is about to roll over in the second half of the year, and they need to lower the rates in order to reduce the cost of that refinancing that they're going to have to engage in, because the deficit is growing, because in the last 90 days it grew by $1 trillion, and that acceleration of the growth of the deficit and the funding of the deficit costs is going to bite down the road. The debt to GDP is at 124%, and it's growing. But whatever the reason, and maybe they're all valid, but no matter, the very pivot is a signal that the Fed is abandoning the inflation fight. It's telling us that the bubble is going to grow in financial assets. And it's going to set the stage for a bubble bust, like what happened in 2000 when these bull runs come to an end. Look ahead to that moment, plan ahead of that moment, and think about what to do. When financial markets turn into a speck in a bubble, and then that bubble starts to disintegrate, people sell. Then they move the money that they had into the risky assets, into the most stable instruments that they can. Now, from 1980 to 2022, that's been Treasury bonds. Treasury bonds would go up when stocks went down until 2022, and then that trend no longer worked. Why? Because the bond market went into the secular bull market in bonds that started in 1980, and in 2020, when interest rates went to zero, they could no longer keep going down. They hit the floor basically, and the debts hit record levels. Which made the bull market unsustainable, the secular bull market. So the bond market no longer acted as people expected in 2022, and the 60-40 portfolio didn't work like it did in the past. Both bonds and stocks fell in 2022 when that bear market came. When the next bear market comes in the stock market, most likely the same thing will happen again. So the bonds won't act as the instrument of stability that it had acted for 22 years. People will turn to gold and silver because throughout human history, it's gold and silver that has acted as that stable instrument. In 2022, gold and silver outperformed the stock market and bond market were up that year. In the 1970s, both, of course, outperformed. In the 1930s, both outperformed. That's just to talk about U.S. financial history. But since the dawn of man, gold and silver has acted as commodity forms of money, linked, the closest linkage there is to real physical commodities. Things that are not speculative, fictional, financial, capitalistic instruments, but linked to the real world, solid that you can hold. And they don't go up and down 10% in a day like you see in the crypto coin market. So it's gold and silver that will do well in the next bear market in the stock market when it comes. And they're already starting to do well now. Gold has gone to a new all-time high already last week because of the funding issues, because of the difference in the way the bond market acts today than it did before 2022. So I think gold is going to do well as we continue the stock and Bitcoin rallies and runs. And then when they go down and when those runs end, gold will just go up even more as money flows out of those markets and into the safe havens. But now is the crypto moment. And when you're in a bubble in the markets, what happens is that a sector, an element of the markets will start to go up more than the rest of them and capture the imagination of the masses. And it's typically the most speculative element or portion of the financial market that does that, because the prices of that sector can get delinked from reality. That's what happened to internet stocks in 1999, 2000. Back then, the internet was new, and people were saying things like these websites are going to make all this money. So even if they're not making money now, they got all these page views. We're going to buy them because of the page views. That's literally what people are saying. And these were companies that the stocks soared and went crazy, but the companies were losing money, never made money, and they went bankrupt a couple of years later. But that was the element of the stock market and the financial markets that went wild in 2000. Now it's crypto. And crypto has no linkage to the real world. Cryptos don't represent ownership in stocks, not commodities, nothing tangible. And so people don't use fundamental metrics of any sort to price Bitcoin or figure out where the Bitcoin might go. Instead, they use their pure imagination. And that's why this is the crypto moment, because in an easy money situation, in a bubble situation, the imagination can take hold and go wild. And that's what the crypto gurus are doing right now, delivering countless predictions of more and more gains. I'm not going to play the video, but this is a video of Kathy Wood saying crypto is going to go to 1 million, or Bitcoin's going to go to 1 million. Completely made up out of thin air, with no justification for that prediction. But this is what the gurus are doing, and this is what the masses are believing in. Completely disassociated from any connection to fundamentals or the real world. The problem is these gurus will never tell people when to sell, so they'll be left holding the bag when the top in crypto is made and things turn down, just as what happened 2 years ago. They'll be left abandoned. At the same time, in this moment, as gold and silver become the critical things to buy, not just for the future, but to play the game now, there's zero interest growing among the masses, despite the fact that gold went to a new all-time high just last week. What you're seeing right here in this image is the Google Trends search data. It shows you how the number of people, in this instance, typing the keyword gold price is going up or down, and it hasn't gone up in the past 2 months. It's actually gone lower than it was at the beginning of February. It's lower than it was at the end of November. It's lower than it was a year ago, 12 months ago, almost by 25%, despite the fact that gold's been going up, despite the fact that gold made a new time high, despite the fact central banks around the world are increasing their gold purchases. The masses' interest in it is lower now than it was a year ago. Why? I don't know. They're totally asleep on the start of this new trend. I guess they're so obsessed and mesmerized by the action of Bitcoin that they can't take their eyes off anything else. Yes, it's true, and I've said it, that the stock market may be overvalued by historic standards, as I point out, the cyclically adjusted PE ratio. But at least stocks are shares that represent ownership of companies that exist in the real world. The problem with the internet bubble is that in 1999, most of those companies went bankrupt, these internet stock companies, so the shares became worthless and vanished and no longer exist. But most stocks will continue to exist in the years to come. There is some connection to the real world, the dividends, earnings, breakup value, nothing with crypto. So it is the crypto market that's the most dangerous element of the financial markets right now, and will be when the bubble peak comes. I'm not sure when the rally will end. I'm not sure when the stock market will top out. This rally really started as a cyclical bull market that started at the end of 2022. In 2022, at the start of that year, I was bearish on the markets and maintained a bearish stance throughout the year, despite all the bottom calls the gurus made. But in 2023, at the start of the year, I shifted and became a bull. I said, we're starting a cyclical bull market. Even at that moment, at the beginning of that year, most still doubted. I did not. But now I'm telling you, this market is mature. We're in the ninth inning, and although I cannot see signs of an end in the next week or the next month, the signs will materialize. They will come over the horizon. And what I'm doing is looking and every week being patient and just, being careful here, hoping that when they come, I'll be able to spot them and I'll be able to warn them to you. It could happen this summer. It might happen after the election, but it will happen. One sign that the end is here when it comes is this chart. This is the yield curve. Now, you may have heard a lot of people talk about the yield curve and say it's the most accurate predictor of recession when it goes negative. Historically, a recession starts 6 to 12 months later once the yield curve goes negative. That happens when the yield curve measures the yield on the 2-year bond, and the 10-year bond negative is when the 2-year goes higher than the 10. And we've been that way since the beginning of 2022. And we remain that way till this day. But if you look at history, the recessions really start when the yield curve shifts from being negative and turns positive. It's still negative, but you can see on the chart where I circled, it turned positive like this last in the fall of 2007. And when it did, the stock market rolled over and disintegrated for 2 years. And that's when the crash happened in a year later. But when the yield curve shifted and went from negative to positive, that's when it all started and turned into a bear market, and it just built. Same thing in the fall of 2000. The bubble in the market, the internet bubble, popped in March. The yield curve inverted in the fall, and in the fall is when the S&P 500 rolled over and the entire stock market rolled over. And the bear market lasted for 2 years after that. So this is a key indicator when I'll be keeping my eye on it for the rest of the year. And it's just a matter of time. But we're not at that situation now. It's not likely to happen in April. Probably, several months from now. Second half next year, or first half of next year. But here's an important fact. In the fall of 2000, when the yield curve inverted, gold made a bottom and began a secular bull market and outperformed the stock market for 12 years. That's likely to be what happens again. And when that shift began, the move in gold accelerated and mining stocks exploded and went wild starting in 2002. That's why gold is so critical, and why I've been holding 14% of my accounts in metals ETFs for the past couple of years, and actually boosted that exposure at the very start of this month on the day that gold rallied up, or was that very last day of February, I think, when gold, as you can see on this chart, had the big day and closed right below 2,100. That's when I boosted my exposure, and I boosted a little bit more as this month went on. Now, at the moment, gold made that new high on Thursday and pulled back. It looks, we're retesting 2150. We'll see if we hold that level. Good chance we will, but it looks like we're going to go sideways here, and that's fine. A little breather and a pause. That's what markets do. And silver tapped on $26. We got close to it, came back down. So, 26 is the 2100 equivalent on silver. We haven't broken it yet. So I still think we're in a good buying time for silver, gold, and the mining stocks. So that's my update for this week. If you want to get these articles in this one I just went through with you, what you need to do is go in the description of this video, click the link, subscribe to the completely free newsletter, and you'll get it. If you want more analysis like this, hit like. If you want my next video from YouTube and you're new to my videos, hit the subscribe button, hit the bell next to that, and YouTube will send you an alert as soon as that next video is up. And I'll be talking with you later.